Hi, everyone. Thanks for joining us today. My name is Mario H. Maria. I'm a senior wealth advisor here at SRP, and I'm joined here today by Bob Wagner, our CIO of SRP as well. Just want to give you all an update on the first quarter of 2023 going forward, as well as an update on kind of where we are and where we expect to be going looking forward here. So, Bob, why don't you kind of walk through what's been happening the last year and a half, both on the headwind side as well as what could help us looking forward as tailwinds?
Okay, I didn't. This is a familiar chart to most people that have sat through client meetings in the past. I didn't really make any changes here, other than what I did was I expanded a little bit more about some of the headwinds. We've got a great deal of fiscal spending going on. We got a 1.7 trillion omnibus fiscal spending package. We've got a 1 trillion infrastructure bill, and we got a 738 billion Inflation Reduction Act. So there's a lot of monetary spending that's going on. But remember, we're doing this fiscal spending during a period of monetary contraction by the Fed. One other thing that one additional line that I did add here was the gridlock in investigations in Washington with the most recent election. That's probably going to be that's a change. But other than that, I really didn't add too much to the headwinds and tailwinds. The geopolitical concerns are still there. The threat of a recession are still there. COVID's still there. And the restrictive monetary policy is still there.
Yeah, but I think the key point here too, Bob, it's really the headwinds that we've experienced, right? And looking for the next slide kind of shows you what we've experienced last year and how rare of an event that was, not just in 2022, but looking forward or backwards the last several decades, right? On the traditional 60/40 portfolio.
Yeah, the last year, the way to describe it was an outlier year. As you can
Yeah.
see from this chart here, that last year for the 60/40 portfolio was the third worst year going back to the Great Depression. And that kind of shows you the extreme nature that was. Now, if you take a look at the absolute magnitude of fixed income and equity and chart those out, you have to go all the way back to 1873 when data started to find something. So this was literally an outlier year. Now, what happened last year was we had that tremendous shock in the yield curve where we had a parallel shift across the entire yield curve. Combine that with the war in Ukraine, disruptive energy policy, China and COVID, and persistent supply chain policies. Just created a very difficult year. And as we finished the year, we had as a monetary policy, we had an inverted yield curve. And what that's been translating into is slowing economic growth. So looking forward, you can kind of say the 2023 is probably going to be a year of uncertainty. Which, as we know, the markets often climb walls of worry, but there's quite a bit of uncertainty still out there.
Right, I think it goes to your point, Bob, of looking forward, where there's both these two clashes of forces at each other, right? It's fiscal policy on one end versus monetary policy, and throwing interest rates in a war. You have all these things in one bucket. It just creates a recipe for disaster in a way.
Yeah, well, this is why it's so complicating. Because what we have is we've got the two major levers that the government can work is monetary and fiscal policy. Well, our fiscal policy is pretty expansionary. I mean, there's a great deal of spending going on. The debt is on pace to exceed where we were in World War II. But also, not only do you have fiscal policy spending, you have a recovering China. Right. So you have a tremendous amount of potential demand coming online in the following year. Now, the problem with that is, what's the Fed trying to do? The Fed's trying to fight inflation. So what are they doing? They're trying to slow down inflation. So you've got demand destruction intended by the Fed, and then you have demand creation by fiscal policy, China, and the rebounding global economy. So we're in a tug of war situation, and we don't know who's going to win that one. Basically, we're just going to have to wait and see. But it's going to be an interesting year, and it just goes back to that outlier type of a discussion. This is the type of situation you don't see very often. It's typically difficult for the market to understand who's going to win. I mean, you have two countervailing forces. We don't know who's going to win, and throw in the inverted yield curve and the talk of recession. So it's you can kind of see 2023 is making out to be a kind of interesting year.
Exactly. And this is kind of the next slide here. What I'm telling clients on the individual side, it's all these different things happening all at once, right? You have inflation being one issue. You have the Fed raising interest rates, which impacts both equity and fixed income markets. And then you have GDP. So are we slowing down as an economy? And then the big driver of any economy is earnings too. Looking forward, what's happening with companies? Are they making money?
Yeah, the way I put it is this is the recipe for a recession. You had a spike in inflation, It triggered a spike in Fed funds rates, triggering a slowing down of GDP. Now, as far as for the investors go, and why this is important, is so far the market's corrected, but it's largely corrected due to the fact that interest rates increased, and we experienced what was called a multiple contraction.
Yep.
So the PE came down, but what you normally look at with the equity markets to say, okay, whether they're going to go higher or lower, are forward earnings. So as you can kind of see, during this period of rising rates, rising inflation, slowing GDP, forward earnings have remained relatively strong. The problem we face going into 2023 and the talk of the recession is if that takes hold and you see forward earnings roll over, that could lead to another down leg in the equity markets. But fortunately, now that we have decent rates on the bonds can maybe provide a ballast this year. But as you can kind of see, once again, this fits into that story of looking forward. 2023 might be a challenging year.
Yeah, it's kind of funny how these all I view almost like a domino effect, right? One impacts the other as they start falling. And that's really what this is the issue with, right? Supply side and unemployment and inflation. And you've made the comments, Bob, where how can you have a recession when unemployment's so low?
Yeah.
Where usually it's the opposite.
Yeah, and that's once again that's why this is such a complicated market. I always and if you put the argument into a nutshell, what's really going on is the Fed is trying to solve a supply side issue with demand side tools, right? They rise interest rate, that controls the demand. What they're out there is they're trying to what's called demand destruction. They want to stop people from buying to get inflation down. Well, the problem is, the reason prices are going high isn't because of demand. It's because, like with eggs, you took a bunch of chickens off the production line. Right. So if you take a look here, typically when you look at inflation, you're looking at unemployment. Unemployment, if you talk to an economist, they'll typically say you can't have sustained inflation unless you have sustained low unemployment and wage pressures. Well, the problem is, that's right for a normal post-war economy that's growing in population and growing in growth. What's been happening recently, though, as you can kind of see, the labor force participation rate has been going down. People have been leaving the workforce, and that has corresponded to a lowering of unemployment. So that's typically not the type of low unemployment you expect. You expect low unemployment because many people are going to jobs. Well, this is a situation where people are dropping out of the workforce. So that's a different scenario. Once again, the Fed can't do much about people retiring. The problem is, once again, they're trying to fight a supply side issue with demand side tools. So they're working on demand destruction. Well, as you can see on the second chart, you can kind of see that as GDP has come down, they have been able to destroy demand. But the problem is inflation hasn't responded. Inflation's continued to go higher, even though GDP has gone down. And once again, why? Because if you have an issue with chickens, you get fewer eggs. If you have an issue with baby formula, that's going to drive prices higher. And if you have supply chain issues coming out of China, and then of course energy prices, all those problems aren't going to be solved by demand destruction.
Yeah, even unemployment too, Bob. If you make wages more expensive, right, eventually that cost carries over to the consumer.
Well,
so
yeah,
it's all that stuff too.
Yeah, that's my point. Talk to an economist, they'll always say that you can't have sustained inflation without wage pressures and low unemployment. Right. And so in this situation with low unemployment, yeah, that's once again a difficult thing to really get under control if there's a shortage of labor, which there is. And so, this just this comes back to this year it's setting up to be pretty interesting. Now, the other thing that's kind of interesting there is that the Fed has a target of 2% in inflation.
Right.
Once again, 2% in target is a target that they normally have during a normal type of an economy. Once again, if you have a 2% target during a period of labor shortages, you're probably going to have to overshoot. That gets into another situation where the Fed has what's called a dual mandate, where they have to maintain low unemployment and stable prices. Right now, they're almost exclusively fixed on stable prices. Okay. But if they go overboard and they start to get unemployment too high, especially unemployment too high during a labor shortage thing, you're really going to have a shock to your GDP. What will that trigger? A lot of people howling in Washington, and probably for them to change directions.
Yeah, and that kind of goes over this thing where we see the news, right? What's headline inflation or headline CPI versus core CPI? Because they still measure a change in prices, but one of them looks at general inflation when you take out food and energy, which for most consumers, they care about that, right?
Yeah, well, this is a great example of what demand destruction is. right? There's a core inflation, and then there's the headline inflation. Now, the headline inflation contains food and energy and the other volatile parts, right? That's the light blue. And as you can see, as the Fed's raised rates and as we've opened up the strategic petroleum reserves, we've been able to get that headline inflation to roll over because we've been able to supply. We've been able to address some of the supply issues, namely with energy. Problem is, take a look at the core inflation. It's been relatively stable even while the Fed raises rates, and that's the problem. It's sticky, right? The other problem this creates is what's going on now. Sure, you've gotten the oil prices down. You've been able to roll that headline inflation over with, but why did it roll over? Largely because of temporary issues. Opening up the strategic petroleum reserves have gone from putting more oil on to actually, as they look forward, they'll probably be taking oil off the market. But more importantly, there's a rebounding China.
Mm-hmm.
China demands a lot of energy. And so as you can kind of see that, sure, they've been able to temporarily slow the ascent of energy, but more than likely, if China gets rolling again, if this fiscal spending starts getting executed, you're going to see most of that turned around again. And it just puts us Feds in a worse situation because, how's the Fed going to react? They want to demand destruct, they'll raise rates even higher.
Right. And I guess the last thing we're talking about, Bob, it's kind of what's happening here with our dollar, how that impacts overseas international, and looking forward of our dollar's been gaining a lot of momentum the last year and a half, just given how fast rates have been going up.
Yeah, to me, the dollar is the wild card next year, or this coming up year. Last year, we were able to drive the dollar to a multi-decade high because our interest rates went up so quick and the foreign markets did not. Right. Well, now we're getting to the end of the rate cycle on our side, and more than likely, we're going to start to see rates rise overseas. So the spread will narrow. Now, remember last year, as that dollar went higher, what did it do? It contained inflation. Right, a stronger dollar is disinflationary. So we had high inflation last year, but it was lower than it really should have been without a strong dollar. Now, the problem is looking forward, we still have relatively high inflation, but what was an inflation headwind is now going to become a tailwind because if the dollar does roll over, what's that going to do? That's going to stoke inflation. And so that's one of the problems. If you take a look at domestic versus equity investments, this is probably going to favor foreign investments over domestic because as a weaker dollar, as we saw in the fourth quarter, that helps the performance of the foreign equity markets. And also, if you take a look at just the structure of the two markets, the foreign markets are probably better designed to weather higher interest rates than the U.S. are. We're more skewed towards growth, whereas they're more skewed towards finance. So if you look forward, if the dollar rolls over, the dollar can have some major impacts on what trends will do well coming forward. It can stoke inflation and help the performance of international companies over domestic. But of course, the caveat: if you roll over into a recession, all bets are off.
Right. And then that's a good point because even this year, I mean, it's mid-January when we're making this video, and so far internationals leading the charge on the equity markets versus U.S. for that reason, just how much the dollar has come down a little bit in the last few weeks.
Yeah.
Well, with that said, Bob, I appreciate your time and thanks for giving us an overview just of the markets looking backwards in 22 and then outlook looking forward. If you have any questions, please feel free to reach out to any of us at SRP. But thank you for your time, and I wish you all the best as we head into 2023. Thanks, Bob.
Thanks, everybody.
Take care.